If you are self-employed in Alberta with a 450 to 650 credit score, you are not automatically declined. You are usually just trying to qualify using the wrong strategy, and that's why people keep telling you come back in 2 years. Today, I'm going to show you the exact 3 lanes lenders use, give you the insider secrets on how to pick the right lane based on your credit score, and give you a step-by-step checklist to get pre-approved without waiting months or lowering your score even further. This video is for self-employed Albertans who make good revenue but write off a lot, who are trying to buy in the next 3 to 12 months and have a credit score anywhere from 450 to 650. I will not be telling you to just pay down your debt and wait. I'm here to give you actionable steps that you can take today and get your mortgage as soon as possible. By the way, my name is Ushindi Mutabazi. I'm a mortgage associate here in Alberta, and I specialize in helping self-employed Albertans like yourself qualify for a mortgage without waiting 2 years for income averages, paying more in taxes, or changing the way that you run your business. There are 5 parts to getting a mortgage with a credit score under 650, and the first part is the 3-lane approval map. Most people think a pre-approval is just a credit score plus your income, then you get a yes or a no. Not necessarily. Depending on the situation, lenders put you in a lane first, and that lane is what decides the rules they use to evaluate you on. Lane 1 is the insured lane. If you're buying with a 5 to 19% down payment, this is the lane you're typically in. This lane is strict, especially when it comes to your credit. If your score is below 600, this is a tough lane to get in, unless you have a co-borrower who has a score above 600 and the rest of your file is fairly strong. Lane 2 is the uninsured lane. Once you have a 20% down payment, this is the lane you're in. In this lane, credit still matters, but lenders can be more flexible depending on your down payment, stability, debts, and the income documentation that you have. If you have a credit score under 600, but you can still get a 20% down, just by getting that down payment, you have instantly increased your options. The final lane is the alternate lending lane. This lane has more flexible qualifications and lenders are more willing to work around your situation, but with that comes a higher rate, sometimes a fee, and often bigger down payment requirements. Regardless of the rep on the internet, alternate lending is not necessarily bad as long as you have an exit plan. It should be used as a bridge strategy if you want to buy it now, improve your credit score over the next couple of years, then we refinance, and by then you'll also have some equity in the home, which puts you in the perfect position. That being said, credit gets you in the door, but income presentation is what decides how big of a mortgage you actually qualify for. So part 2 of getting a mortgage is avoiding the self-employed mortgage trap. Self-employed mortgages aren't based on how hard you work, they're based on your documents. And lenders don't qualify you on revenue, they qualify you on the income that shows on paper. You might be making 200K in revenue, but after write-offs, your taxable income might be 60K. And the 60K number, that's the number that most lenders will qualify you on. So before you apply, you need to do some research and know what income the lender will actually use and which lane you are trying to get approved in. A 450 to 650 credit score is a very wide range. So in part 3, I want to break that down into 3 different groups and give you a different plan for each specific group. The first group is a credit score of 450 to 549. If you're here, your goal is stability first, approval second. If you happen to be in this group, there's usually late payments in the last 12 months, high utilization, maybe accounts and collection, too many inquiries, or just no credit history at all. So here's what you need to do if you're in this group. First, stop all new credit applications. No dealerships, no store cards. Second, if any payments are already late, pay them. And also, set up auto payment right after this video. Third, lower your utilization. If your cards are near the max or even over, that's an automatic score killer. Aim to get the utilization under 50%, then 30%, and if you can, 10% when possible. Lastly, pick the lane that matches reality. If you're under 20% down, an insured mortgage is very unlikely, at least for now. You should be planning for a 20% down payment, a bridge strategy, or a longer timeline. If you want help figuring out which option is best for you, feel free to message me on Instagram and I can 100% help you out. The link for that will be in the description. This video is sponsored by myself. If you're looking to buy a home in the next 6 months or just want some clarity on your current position and where you stand, click the first link in the description and complete my 3-minute mortgage readiness quiz. It's completely customized, and once you complete that quiz, I will personally record you a custom video within 24 hours, breaking down your real numbers, explaining exactly how a lender would view your file, and laying out a clear approval strategy based on your timeline and your goals. This is not automated, it's me doing the work. Also, make sure to follow me on Instagram at It's Ushindi for more self-employed mortgage advice, or if you have any questions and just want to chat, a link for that will be in the description as well. Let's get back to the video. The second group is a credit score of 550 to $599. This group is where strategy matters most because a lot of people can push that credit score into the 600s within 30 to 90 days if they stop doing the wrong things. So here are the things you should be doing in order if you are in this lane and looking to get a mortgage. Number one, get your utilization down fast. This is the fastest lever for most people. Number two, no late payments, not even once. Number three, know your inquiries for the next 60 to 90 days. And number four, clean up any credit report errors. If a collection is paid but it's reporting wrong or if something isn't yours, make sure to properly dispute it. The last group is if your credit score is between 600 and 650. If you're here, you're typically not too far off. In this group, approval usually fails because of income presentation, debt ratios, inconsistent documentation, or just messy down payment sourcing strategy. So here's what you need to do. First, keep your utilization low, under 30%, ideally under 10%. Second, avoid new debts before getting your mortgage. And third, prepare your income story correctly. Now that all that is out the way, if you want the pre-approval that actually holds up, here's the checklist you need to complete before you apply. The first thing on the list is knowing your lane. You need to be able to answer these two questions. Do you have less or more than 20% down? And is your credit score under 600? Is it in the high 500s or is it over 600? Get very specific. You need to know your numbers. The second thing you need to do if you want a pre-approval that holds up is organize your down payment sources. Lenders don't just care whether or not you have the down payment. How you got the down payment is just as, if not even more important. To get the pre-approval that you're looking for, start by just moving your down payment into a clean, trackable place and keep the records preferably in a PDF format. Third thing on the checklist is your self-employed documents. Depending on your setup, you may need your T1 generals, your notices of assessments, your T2125 if you're sole proprietor, corporate documentation if you're incorporated, and the business bank statements. Pro tip, please keep your business and your personal banking separate. It will ensure your approval gets done as quickly, smoothly, and cleanly as possible. If you need help figuring out which documents you need and how to actually find them, send me a message on Instagram and I can definitely help you out with that step as well. Fourth on the checklist is cleaning up your debts and controlling your ratios, because even with a high credit score, high monthly debt payments can kill your approval. So for this step, list every single monthly debt payment that you have, check your statements, go back 90 days. Every single monthly payment that reoccurs, list it down. For credit cards, always use your monthly minimums. If you pay child or spousal support, make sure to include those payments as well. Everything that reoccurs. The last checklist item, which is very important, it's an income reality check. Self-employed people get burned because they assume the lender uses revenue. Instead, look at what your tax actually shows as income. If it's low because you have a great accountant and you write off a lot of items, we do not panic. We plan around it, but it's better to know upfront. Now that you have a better idea of what to do in order to get a mortgage, what's even more important is what not to do. So here are the top 4 mistakes that ruin approvals before you even get the chance to tell your story. Mistake number 1 is applying everywhere. Every single lender you go to will pull a separate credit report, and that will only lower your credit score and create more confusion. To avoid this mistake, I would highly suggest you reach out to me on Instagram would work, because my job is to build a proper strategy before we even get to pulling that credit report. You and I schedule a call. We'll talk about your business, your goal with home ownership, and your current situation. Once we're aligned on what the goal and vision is, I only pull your credit report once and at the right time. Using that report, I talk to tons of different lenders, but not randomly, only the ones that actually match your goals and situation, so we can find the perfect fit for you. Mistake number 2 is trying to force an insured approval when your credit score isn't even above 600. If you do this, you're only going to waste your time and end up discouraged, and as a business owner, you most likely have more important things to do. The third and most common mistake is focusing on rate before structure. The goal is not to match the rate your neighbor got. The goal should be to build the right mortgage for you based on your timeline, the monthly payments you're comfortable with, your down payment situation, and how your income is actually structured and shows on paper. Then we shop for the best rate that fits your plan. We start with the end goal in mind. Lastly, mistake number 4, and this one you cannot afford to make, is staying confused for another 6 months. To avoid that, start by completing my 3-minute mortgage readiness quiz. I get it. You're busy, you're not sure if you're ready, you don't know what to expect, you might even be a little scared to find out, but that's exactly why you need to take that quiz right now. Once you complete that quiz, I will personally record you a video within 24 hours, breaking down your real numbers, explaining how a lender would view your file, and laying out a clear approval strategy based on your timeline and your goals. This is not automated, this is me talking directly to you. And also make sure to follow me on Instagram at It's Ushindi for more self-employed mortgage advice. I usually post daily, or if you have any questions, you can message me on there as well. A link for that will be in the description.